The S&P 500 is looking a little down today. In fact, it is the first time the S&P is down since the election, and this has ended a 4-day run where we saw stocks go to all-time highs after Donald Trump was elected for his second term as US president. Now, we also notice the fear and greed index is sitting right firmly in the greed spot. As always, market sentiment can change very quickly. Just 1 week ago, we were firmly in neutral. Now, today we're focusing on 5 cheap dividend stocks that we believe every investor should consider in their portfolio. We're going to talk a little bit about each one's historical performance, the metrics, and our own valuation. First one needs no introduction, Johnson & Johnson, the dividend king. They're up only around 4% over the last 12 months, so they have underperformed the S&P. In fact, over the last 10 years as well, whilst this doesn't incorporate dividends reinvested, it is up only 42%. Now, when we take a look at it, it is trading towards the lower end of the 52-week range, where we get a double buy signal from Seeking Alpha and Wall Street with a hold from Quant. Now, it also offers a very attractive yield of 3.2% and a forward P sitting around 15.6, which is lower than the S&P 500, which sits around 25.5. Now, as always, each one of these, we are going to take a look at their earnings expectations and historical performance. Important to understand, over the next 3 quarters, they are expecting a decrease to the year-on-year EPS. But what we like about this company, the previous 4 quarters, they do have a good track record, 4 out of 4 beats, 100%, which does give us some faith when we look at the projected December 2025 EPS for the next full year at 10.63, showing growth to the overall earnings per share, which in turn does lower that forward P to 14.6. Now, dividend safety 99, very safe. That is the highest score obtainable, and severe undervaluation on both the yield as well as this model, which we will cover shortly. And just this year in April, they increased the dividend around 4.2%. Remember, on this channel, at a bare minimum, we do want to see 4% just to keep up in line with inflation. Now, it was just a couple of weeks ago where it was reaffirmed their very safe score, ultimately meaning for this dividend king, a dividend cut is highly unlikely. Now, we'll look at each one's key metrics, and this hones in on essentially the 07-09 Great Recession, how they performed. Dividend king, therefore no surprises, they continued to increase it during that 07-09 crash. Negative 6.2% sales during that period, well above the S&P's negative 12, and massive outperformance, yes, negative 27%, however the S&P's comparable performance, negative 55. As we mentioned, 4.2% increase to the dividend this year, but over both the last 5 and the last 20 years, we do see an above inflationary increase at 6% and 8% respectively. Then we move on to the growth. As we said, a dividend king, which is illustrated here, 61 years of consecutive increases, essentially a company classified as a dividend king with 50 or more year increases to the dividend consecutively. But on top of that, Johnson & Johnson, 108 years of paying a dividend without a reduction. Now, when we look at this valuation model, what we in fact notice when we zoom in over the last 12 months, the blue tunnel essentially telling us the expected fair value, pretty much reflecting that this company, for the vast majority of the last 12 months, has been trading well below the lower end of the fair value, giving us that severe undervaluation. Do remember though, we're not looking at any one of these models in isolation. We will conclude towards the end when we put it through our own model. In terms of dividend yield theory, tells us a company is undervalued when the current yield sits above the 5-year average, so that is another undervaluation signal. Another one reflected in the forward P, as we can see, 15.2, lower than the 5-year rolling of 16.5. Not only that, it also does trade at a bit of a discount to the healthcare sector, which as of now, today's date, is at 16.7. Now, when we look at the free cash flow payout, and very important, we'll typically focus your attention on that as the earnings data is susceptible to manipulation by management through accounting. Below 60% is what we want to see. Main reason for this, gives us faith management can continue to offer very attractive increases. Now, over the last 2 years, it has gone above that 60%. Nice to report though, previous 8 below that threshold, and over the next 12 months, expected to come down around 61%, something we can live with, as long as at a bare minimum for Johnson & Johnson, they do increase it around the 4 to 5% level. We then move on to the free cash flow per share, where we do want to see consistent increases over the longer term for this metric. Now, it has increased 2014 to 2023, inconsistent, so do consider that, but nice to see over the next 12 months an increase is anticipated, quite a significant one, to $8.19 per share. Then we move on to the sales growth, where we want a minimum of 3 to 7% year on year. Remember, 3 to 4 just to keep up in line with inflation. Nice to see that in the more recent year of 2023, as well as on a trailing 12 month at the 5 percentage point. We also notice from a numerical standpoint they have been increasing their top line at a bare minimum, keeping up in line with inflation. Just understand, when you do look at companies, have realistic expectations. You can't compare this or have future projected sales growth in comparison to the likes of tech companies that grow at a much rapid rate. Shares outstanding, what we want to see, companies returning excess cash. The way they do this is through share buybacks, increasing your total position, total control over the company. Something J&J do, maybe a little bit more inconsistent than we like to see, but from time to time it is part of their capital allocation. Nice to see, on top of this being a dividend king with very regular increases. Then we get to ROIC, one of our favorite metrics, if not the most prominent one that we do look at. We want to see 10% or more. Give us faith, management are able to effectively allocate their capital. They do it very consistently around the 20% point on average year on year. And remember, typically investors do pay a little bit of a premium for companies that do show that consistency. Now, operating margin, two things we'll always check. First one, above the minimum, as we see, 12% is the preference. It is above the 12%. Second thing we don't get for Johnson & Johnson is operating efficiency, where it increases over time. However, we do like the fact that it is significantly above the minimum 12%, and the free cash flow margin, whilst it's not increasing, still very, very attractive at 20 to 25% year on year, something that investors and potential investors will love to see. We then move on to the final metric, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. That is what we get for J&J, and the numbers below reflect the number of years it would take the company to pay off all of their debt net of cash on hand. And remember our focus on this metric because it correlates to essentially dividend safety that we saw above 99 for J&J, but also balance sheet strength, which in turn tells us Johnson & Johnson, very strong balance sheet, 0.25 in 23, a small increase to 0.49 over the next 12 months, and the dividend, as we saw, does look to be secure. As always, for each of these companies, we're going to jump into the valuation model, and if these episodes do provide value, you do enjoy them, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on our deeper dives, we run through every single model, talking about the inputs and the outputs. Today, we're running through 5 stocks, so we're going to keep it as quick as possible. Intrinsically, then, $180 is what we arrived at, and with the current price, we always like to use an MOS. Now, 10% is where we start off with. Execute on that if it meets our 3 criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that for J&J will buy up to $162, then we keep going till it's near the current trading price. And what we're saying, dividend king, looking very stable over the longer term. It is 15% currently at a buy around the $152 mark where it sits today. In terms of Wall Street, they see 17% upside, a price target of $178, so it does look fairly attractive for those investors who maybe want that secure yield and also don't want an incredibly volatile stock. As we saw in the previous recession, it significantly outperformed the S&P 500, and right now at a 15% MOS, it could be one to consider in the portfolio. As always, give us your thoughts in the comments below as we move along, whether it's a buy, hold, or sell. We also want to let you know we have just released our latest free weekly article. Now, every Monday morning we deliver one to your inbox where we talk about severely undervalued stocks that we think deserve your utmost attention, as well as what's gone in the market over the last few days. So click below, sign up, and you can read straight away. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of 22 undervalued dividend stocks that Wall Street themselves believe right now in this moment have the most upside out of the whole S&P 500. Moving on, we have Mondelez International. Now, Wall Street have given this a strong buy. We also get a fairly rare buy from Quant, and Seeking Alpha this time taking Quant's position, giving them a hold. Now it does trade towards the lower end of the 52-week range, similar to J&J. It does have a higher forward PE sitting around 19, and we can see a forward yield of around 2.84%. Now over the last 12 months, down 4%, over the last 10 years, up around 71%, and we can see all-time highs around a year ago at just under that $80 mark. Now over the next 4 quarters, they are anticipating a decrease to the earnings per share. Bear in mind they do suffer some of the same issues that Hershey does in terms of the rising cocoa prices, but historically, or over the last year we should say, they have outperformed in terms of analyst expectations, 100% track record, but do understand that over the next full year, earnings isn't expected to increase, a marginal drop, therefore increasing their forward PE, although only again marginally to 19.2. They do have a 66 safe score on that dividend. We also see an undervaluation or severe, we'll come on to that in terms of the yield. We'll talk about this model, but very nice to see this August an 11% increase to that dividend. Now, last recession, well, they actually maintained it. They didn't increase it. They didn't cut it. They had below average growth, negative 19%. But even with that, they actually outperformed the S&P, negative 35%. We also love the more recent increases, 11% as we said this summer, 11% over the last 5 years, with an above inflationary increase over the last 20. And when we take a look, they have been increasing those dividends for the last 10 years. Now, when we talk about the valuation model based on the forward PE and zoom in over the last 12 months, we actually notice it has floated around the middle point of that fair value over the period, but we can see it coming down towards the lower end in the more recent. But remember, we will run it through our valuation model. In terms of the yield, well, actually, this is the highest yield it has offered over the last 5 years and above the average, 2.83 versus 2.27. But the forward P isn't too far off the 5-year rolling, 20.3 versus 20.9. We do also note it is above the consumer staples at 17.9, but as we often say on this channel, some companies do deserve a premium to the overall sector, and when we do our deeper dives, as I'm sure you're aware, we do compare a lot of metrics of companies against the sector median. Now, free cash flow payout below 70%, so we lift it for consumer staples, pretty much below that every single year, 57% over the next 12 months, so no worries in terms of that payout. Then we get to the free cash flow, which is looking good, more than double over the longer term. In fact, over the last few years, with nice increases year on year, expected to go much higher over the next 12 months to 332. We also like their sales growth in the more recent period from 2020, where in fact it has been climbing, but do note over the trailing 12 month, it is expected to come down from the highs of 2023 at 14%. Over the longer term though, we do notice growth, but again, similar to Johnson & Johnson, have realistic expectations when you are considering these companies. One very positive thing though, we do like to say, they have been doing a lot of share buybacks, as we can see here. In fact, buying back around 20% of those total shares outstanding from the last 10 years. And then we move on to the ROIC, above 12% for consumer staples. Now it has been below that, but nice to see the increase in both the more recent period as well as the trailing 12 month. So a good sign, remember one of our most favored metrics. Operating margin, not just above the minimum in the more recent period, but gone from 12% in 2014 to 17% in 23 and on a trailing 12 month. Free cash flow margin also looking very, very good. Finally, the net debt to EBITDA. One thing I actually love about companies like this, not only is it below 4 in 2023, but we see it decreasing from 2014, telling us or signaling the fact that management do consider delevering the balance sheet, paying off their total debt, and it has started to decrease. 2.33 in 2023, a smaller increase anticipated over the next 12 months. Dividend looks good, and the balance sheet also looks good based on this information. Now, our intrinsic value of $81, first things first, pretty much bang on with what Wall Street see in terms of movement over the next year. They see 22% upside, and when we run it through the MOS, at 10% a buy at $73, at 15% around $69, and in today's episode we are pretty much saying around the $65 mark, you are locking in a 20% MOS with 22% upside. And whilst we haven't done a deeper dive, do understand it does face some of the issues that Hershey also faces in terms of those rising cocoa prices. So maybe 20% is enough in terms of an MOS. For those that want to know, 25% $61 and 30% $57. But as we said in today's episode, 20% around the $65 mark. And you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Mondelez or any others that you do desire. We then move into the semiconductor space. Qualcomm taking a bit of a hit today at 3.2% negative. We have a double buy rating seeking alpha in Wall Street, with quant restoring order coming in at that hold. As we said, trading towards the lower end of the 52-week range. Forward yield, the lowest so far at 2.02%, and a forward P sitting around 15, around the same as Johnson & Johnson that we did cover at the beginning. Over the last 12 months, though, best performing so far, up 31%. Over the last 10 years, up around 128%. Then we move on to their earnings, looking good. The first one with growth every single quarter over the next year, and also outperformed management targets over the last 4 quarters, with growth anticipated over the next full year, September 2026, massively lowering that forward P to 13.6. We then have an 80 score on dividend safety. We have that safe point, and then we also notice a double reasonable signal with an increase above inflation at 6.3% in March this year. In terms of the last recession, well, they increased the dividend, they had above average growth, and they also massively outperformed the S&P, negative 21%. 6% increase, very similar to that of this year in March, but over the last 20 years, they have been increasing those dividends at 15% year on year. 21 years of consecutive increases, meaning they are 4 years away from gaining dividend aristocrat status. In terms of the forward P, when we zoom in over the last 12 months, they've had periods where they've been fairly overvalued, as we can see around June, July this year, but right now it is sitting towards the lower end of that fair intrinsic price, something we'll touch upon shortly. And in terms of dividend yield, well, we do get what we would say is a reasonable signal. Both the yield as well as the forward P aren't that far off their 5-year averages. However, we do notice it is trading at a massive discount to the information technology sector. As we said, some companies do deserve a premium. Some companies also do deserve to be trading at a discount. Free cash flow payout below 50% for semiconductors, something we have seen over the last 4 years, expected to continue over the next 12, so we would ideally like to see a higher increase in 2025. We then move on to free cash flow per share, where we do see it in fact more than triple from 2015 to 2024. Nice to notice, around 8% increase anticipated over the next 12 months. And we also see this industry very cyclical, and Qualcomm can be noted that through their numbers. In fact, 5 of the last 10 years have been negative, 9% in 2024. Then we move on to a numerical basis, and we can see, whilst not doubled over the long term, we do notice it has increased pretty much more than the previous 2 companies. 25 billion in 2015, just under 40 in 2024. Whilst we see a lot of shares being bought back, we do notice over the more recent period, this hasn't been something that management have been focusing on. And then we look at the ROIC, very, very strong, even though it has been inconsistent. Still, the numbers they are putting up, especially over the last 7 years and on a trailing 12-month, do look very attractive at 25% in 2024. And again, inconsistency does show through. You could argue the cyclicality, but still well above the minimum, both operating side as well as the free cash flow margin. Net debt to EBITDA, again, very, very good, like we saw with Johnson & Johnson, 0.14 in 2024, 0.13 over the next 12 months. This is something that we do find, like ROIC, to be a very important metric to always consider when analyzing companies. Now, our intrinsic value, $217, MOS at 10%, will buy at 195, at 15% around 184, and we can see in today's episode for Qualcomm, we pretty much see trading at a 25% MOS, with Wall Street indicating right now 30% upside, $210 price target. Now, for someone who does want to consider the semiconductor space, you may not be as confident investing in individual companies, so do consider looking at others like ETFs that cover the semiconductor space. There's SOXQ, there's SMH, and many others. If you do want any more suggestions, do put a comment in below, and I'm sure there will be people who have a lot of suggestions. We then move on to the Procter & Gamble company with just a buy rating from Wall Street and a double hold from Seeking Alpha from Quant, trading in the mid to upper end of the 52-week range, although we do notice a pullback in the more recent period from the highs of $178, a yield of 2.42%, a forward P just below 24, over the last 12 months, up only 9%. Over the last 10 years, up around 88. Remember, these don't incorporate dividends reinvested. We also like the fact over the next 4 quarters they are expecting growth every single one to the EPS, and we also notice they have outperformed 100% track record, with growth expected in June 2026, their next full year accounts, lowering the forward P to 22.4. Now, similar to Johnson & Johnson, a 99 very safe score, took reasonable signals with a nice 7% increase in April this year to the dividend. So in terms of looking at the last recession, well, they actually increased the dividend above average growth whilst also outperforming the S&P, and we do notice pretty much around mid to high single digit increases over both the last 5 and the last 20 years. Similar to Johnson & Johnson, a dividend king, 68 years of consecutive increases, but that's not all. They've been paying a dividend for 134 years without a reduction. In terms of the forward P, the valuation aspect does show us right now it is trading towards the lower end of that expected fair value bucket. And when we take a look at the dividend yield as well as the forward P, these two signal reasonable valuation as they are pretty much trading around the average of the last 5 years. However, in comparison to consumer staples, Procter & Gamble right now does trade at a premium. In terms of free cash flow payout, while consumer staples below 70%, that is something Procter & Gamble gives to us nearly every single year, 59% anticipated over the next 12 months. And when we get to free cash flow per share, it may not be something very fancy. Nonetheless, it does pretty much increase every single year, although we do notice a small drop anticipated over the next 12 months. We also notice, especially for the last 7 years, around a 3 to 7% increase year on year, although the last 2 years have dropped marginally to 2%. And when we do zoom out, again, as we can see, not fancy in terms of the large growth, but again increasing the vast majority of the period. We also notice they have returned excess cash, but very inconsistent, but nice to see nonetheless. When you do zoom out, the share counts are reducing, not increasing, and not staying flat. In terms of ROIC, not only very strong above the minimum, but increasing from 13% to 23% in 2024. And then we move on to the operating margin, where I'm sure you know what we're going to say here. Not only above the minimum, but also that operating efficiency, 25% in 2024, and the free cash flow consistently very, very strong. We then finally look at the net debt to EBITDA, something we love to see. In fact, around 1 anticipated over the next 12 months. And you may be thinking, you know, this company does trade at a fair premium to essentially the sector, but do take a look at the metrics. We are seeing quite a lot of quality throughout. And in terms of our intrinsic value, well, we have it at $181. Wall Street disagree, 190 with upside of 15%. And when we do run it through the MOS at 10%, pretty much where we see it trading around now. Whether or not that is sufficient, Dividend King metrics do look fairly strong. A lot of people may argue they want a little bit of a larger drop. So at 15%, a buy at 154, at 20%, a buy at 145, at the 25% point, 136. Now, who knows? No one has a crystal ball. It may get there next week. It may never get there. But these are things that we just want to draw to your attention. Today, 10% MOS, 15% upside. And as we said, do give us your thoughts as we go along today. We then move on to another Dividend King, the Coca-Cola Company. Now, we only have one buy rating from Wall Street with a double hold from Seeking Out from Quant. It has come down quite some way away from the 52-week high that we saw not long ago, trading at the midpoint or mid to low end of the 52-week point. In fact, the yield above 3%, 306, a forward P at 22.2, up 12% over the last 12 months, over the last 10 years, up around 43. But remember, this is if you had bought it 10 years ago. For example, if you did take advantage of the COVID drop at around $38, you would be up nearly 100% from your initial investment. In terms of growth, well, they are expecting that year on year, quarter on quarter, as we can clearly see. And over the previous 4, at a bare minimum, they have been in line, 100% track record, with earnings per share next full year going up to $3 expected, lowering the forward P to 21.13. We also notice a dividend safety score of 80 with an above inflation increase 5.4% this February. And when we look at how they performed in the last recession, well, they increased the dividend above average growth, and they also outperformed the S&P negative 31%. Pretty much you expect consistency with this company, 3% over the last 5 years, 7% over the last 20, and if you can get above inflationary increases for a fairly stable company, then that is fairly good to note. 61 years, so Dividend King as we initially mentioned, and 104 years of paying a dividend without a reduction. Now, in terms of this valuation model, over the last 12 months, it has started to come down into that midpoint of reasonable valuation, reasonable expected price. And when we look at something similar but on dividend yield theory, we do notice again pretty much the same as the average over the last 5 years. Forward P, however, at just under 22 is lower than the 5-year rolling of 24, and similar to Procter & Gamble, does trade above the consumer staples at 17.9. Now, free cash flow payout below 70% is what we want. Not something we've seen that regularly, so do be aware. One thing that we do want to have on your radar, 103% in terms of the free cash flow over the next 12 months, which essentially flags to us they're expecting, or management in fact are expecting, to pay out more in dividends than they are generating from free cash flow. Remember, this is why we draw your attention to the free cash flow and don't tend to focus on the earnings. Not something you would have picked up by looking at this 67%. We then move on to the free cash flow, where it is fairly inconsistent again. 187 in 2014, 225 in 2023, and expected to go lower over the next 12 to 188. Then move on to their sales growth. 3 to 7% is what we want. Now, it's been fairly good, but just over the last 3 years. If you do zoom out, 6 of the last 10 in fact have been negative, so something just to be aware if you weren't already. And we can see they in fact reported a higher revenue in 2014 at 46 billion than they did in 2023. In terms of shares outstanding, very minimal things to talk about here in terms of the fact that whilst they have done share buybacks, they've also issued shares to dilute your position. Net effect is a very small amount of shares that have actually been bought over the last 10. ROIC, good to see consistency around the mid-teens year on year, 18%, so it has been increasing over the last 10. And then when we look at the operating margin, does look very strong and healthy, not just above 16, but it has been increasing 30% on a trailing 12 month, with the free cash flow also showing us some very strong numbers. Finally, net debt to EBITDA, like pretty much every stock we have seen today, their balance sheet does look to be in good condition, coming down from the peak of 3.03 in 2020, 2.08 in 2023, 1.89 on a trailing 12 month, 1.78 in terms of the next 12, so it does look good. Dividend looks to be safe, balance sheet also looks to be secure. Now, intrinsic value at $68, when we do a 10% MOS, pretty much around $61, $62, so not that far off. We do see Coca-Cola trading at that 10% MOS. Now, some people that may be enough. Again, a dividend king, a fairly stable dividend yield that they have been paying for over 100 years without a reduction. But again, some people may want a bit more. 15% at buy at 58, 20% at 54, 25 at 51, and at 30% around 48. As we said, around 10% MOS, although Wall Street actually don't agree. They see $76 as their price target. They think this is a steal, yield above 3%, upside above 20%, definitely one to consider in the portfolio at today's date. As always, give us your thoughts below. Are any of these a buy, hold, or sell? Maybe you've been accumulating them, or maybe you are waiting for a sweeter spot to execute. And if you did enjoy the episode, value has been provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.